Hi everybody, and thank you for joining Greenstone's webinar today on the EU Taxonomy for Sustainable Finance. We have about 30 minutes today and a fair bit of content to share with you. So with that in mind, if you do have questions as we're going through, then we would encourage you to contact us directly through the GoToWebinar. There's a questions box, so you can direct questions towards us. And if we have some time at the end, what we'll do is have a look at them, but we'll be circulating an FAQ document around soon after the webinar, and we can come back to you with any direct responses as well. The slides and the recording from today will also be circulated around, and we will also be running lots of other webinars, so you can find out more information about those on our website. So my name's David Wynn, and I'm the Managing Director of North America at Greenstone. And I'm joined today by Rowan Woods, who's a sustainability consultant at Greenstone in London, and works with a range of companies to help them track their carbon emissions and disclose to other major reporting frameworks.
Hi everyone, great to be here today.
Great, thanks Rowan. So during the briefing today, we're going to give you some insight into the background and key features of the EU Taxonomy for Sustainable Activities. We will be discussing some of the implications for companies and investors, and also sharing some practical tips on preparing for disclosure. So for those of you who haven't heard about Greenstone before, we're a sustainability software company. We work with organizations to be able to help them better manage and report their sustainability information. We've been doing that since 2007 and have users in over 100 countries globally. And we deliver this through our three main software solutions: Greenstone Enterprise, which is used from organizations within their businesses to gather information; Supplier Portal, which is used to capture data from suppliers; and Investor Portal, which is used by organizations to collect ESG data from portfolio companies. So that's just a little bit about Greenstone. And let's kick off with a little bit of background about today's topic. So for anyone who isn't familiar with the EU Taxonomy, it is a classification system which defines which economic activities are environmentally sustainable. And it came about because the EU wanted to encourage the integration of ESG factors into investment decision making in order to ultimately mobilize private capital into sustainable finance. So likewise, for quite a long time, the market sought common definitions for what activities are actually classified as green. And so the taxonomy is looking to help companies, investors, and issuers find that common language to be able to communicate. The regulation requires companies to look at their turnover and expenditures and disclose relevant KPIs in line with the green list of sustainable activities. And Rowan's going to be taking us through that in much more detail on the session today. So even though the regulation's not yet quite been finalized, the key features are already known through several reports which have been published to date. So we thought this was a good time to be able to look at those so companies can start familiarizing themselves with this new EU taxonomy. One thing to note, even though we're talking about the EU, even with Brexit, it's still expected that the regulations will be implemented in the UK, as they are part of the package that the UK government has agreed to implement in domestic law to ease the path towards a potential free trade agreement. So that's just worth noting as well. So with that in mind, I'm now going to pass over to Rowan, who's going to take us through the timeline and the criteria and details around this new EU taxonomy. So over to you, Rowan.
Thanks very much, David. So as David just touched on, the taxonomy is a very significant development within sustainable finance. Just to give you all an idea of the timeline, the EU launched an action plan in 2018 on financing sustainable growth. The action plan basically set out a strategy to encourage the integration of environmental, social, and governance factors, or ESG, into investment decision-making. And that was done so they could facilitate the mobilization of private capital, as up to around 290 billion euros will be needed per year just to finance sustainable activities. In May 2018, the EU Commission adopted a package of measures implementing several key actions announced in its action plan, which included a proposal for a regulation to establish a framework which would create a unified classification system, or taxonomy, of what economic activities could be considered environmentally sustainable, basically answering the question, what is green? The same year, the Technical Expert Group, shortened TEG, was established in order to advise the European Commission, and this was comprised of a number of experts from the UNPRI, GRI, and CDP, among many others. The following year, a political agreement was reached on the proposal for the regulation, which created the legal basis for the EU taxonomy. This year, TEG published its recommendations on the proposal, along with a technical annex, and it's highly likely that the European Commission will put these recommendations into law almost unchanged. This summer, the final taxonomy regulation should be published, and in autumn, the EU is also expected to launch a platform on sustainable finance. And we will discuss the key future dates a bit later on, and that's within the context of the specific uses of the taxonomy. So next we have the key documents, which we've listed in this slide, and they're all available at the link at the bottom of the page on the EU Commission's website. These documents are quite lengthy, but they do provide helpful guidance. In particular, the TEG's technical annex, which came out in March this year, is very useful when analyzing technical screening criteria, which we will cover later on. As I mentioned, the finalized regulation will be published in summer this year, so do look out for that. So in terms of the main users of the taxonomy, there are three mandatory groups set out by the EU. The first is financial market participants and issuers offering financial products. And these include pension funds, insurance providers, private equity funds, as well as corporate and investment banks. The second is large companies, so those with more than 500 employees that fall under the scope of the EU Non-Financial Reporting Directive, also known as NFRD. And thirdly, member states and the EU when setting public measures, standards, or labels for green financial products or green bonds. The taxonomy can also be used voluntarily by any other market actors to help raise finance for sustainable activities. For example, companies that are not required to publish a non-financial statement, like small and medium enterprises, or SMEs, may decide to publish information on their website regarding their alignment with the taxonomy. Theoretically, this in turn would then help those companies raise finance for relevant investments. So the taxonomy doesn't necessarily replace companies' existing sustainability policies, but rather it makes it easier for companies with such policies to raise funding for their projects. And as you can see, the taxonomy is very broad in scope and therefore will have significant implications across the market. So next, let's turn to what it is the EU wants the users of the taxonomy to disclose. And this consists of KPIs on the proportion of sustainable economic activities in relation to turnover, capital expenditure or CapEx, and or, if relevant, operating expenditure or OpEx. So a company should break down in percentages their revenue from sustainable activities. Turnover gives a clear picture of where a company currently is relative to the taxonomy, and allows investors to report the percentage of their funds invested in taxonomy-aligned activities. CapEx, in contrast, gives investors a sense of a company's direction of travel, and is a key variable for assessing the credibility of a company's strategy, and also helps investors decide whether they agree with their strategic approach. Products and services that don't invest in taxonomy-compliant activities will also need to be disclosed, and a statement will need to be made saying that the relevant investments do not consider the regulation. So here we have an example of company disclosures broken down by level, which we've taken from TEG's technical annex. So at the top, you can see the asset level and 3 examples of economic activities. So we have economic activity A, which meets the taxonomy criteria, and economic activities B and C, which don't. Reporting at the asset level, the company would need to specify that 15% of its turnover meets the taxonomy criteria, and the other 85% does not. However, if the company then sets a project to bring economic activities B and C in line with the taxonomy, the company can then claim that 100% of its CapEx or capital expenditure at a project level is associated with the taxonomy. Following that project's completion, the company can then state that at a company level, 100% of its turnover is taxonomy compliant. So essentially, this will demonstrate clearly which companies have a higher proportion of investment in sustainable activities and those that don't. And the significance of this is that it will create more transparency within sustainable finance and also encourage investment into sustainable economic activities. So next we turn to where and when to disclose. So large companies must make their disclosures within their non-financial statements or in a dedicated sustainability report over the course of 2022 for climate change mitigation and adaptation, covering the financial year of 2021, and all the remaining objectives should then be covered in the following year's annual report. Financial market participants should disclose in all 3 of their periodic reports, pre-contractual disclosures, and on their websites. And for these, the deadline is slightly sooner, as they will need to make their first disclosures during 2021. And the EU has set a deadline of the 31st of December 2021 for disclosure relating to climate change mitigation and adaptation, and 31st of December 2022 for the remaining objectives. So this slide lays out the 4 criteria that an economic activity must meet in order to be classified as sustainable under the taxonomy. And we will cover these one by one in the next slides, but as a summary, the activity must firstly substantially contribute to at least one of the 6 environmental objectives set out in box 1. And those are climate change mitigation, adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, and the protection and restoration of biodiversity and ecosystems, as you'll see there. The second is that the activity must not do any significant harm to any of the other environmental objectives. And the rationale for this is that an economic activity which mitigates climate change can't at the same time do harm to another objective. So for example, you can't produce renewable electricity if in the processes it harms water and marine resources, as that wouldn't be sustainable. So the taxonomy really sees the 6 environmental objectives as intrinsically linked. The third is that it has to comply with minimum social and governance safeguards, and that focuses on ensuring that a company using the taxonomy is not only environmentally sustainable, but is also a responsible business when it comes to its customers and employees. And the final provision is that it must comply with the technical screening criteria, which in essence is a detailed list of practical and regulatory requirements specific to an economic activity. So let's turn to the first requirement. What do we mean by substantial contribution? So this actually differs for each environmental objective, and the criteria is laid out in full in Articles 6 to 11 of the draft regulation. Currently, the EU has identified 70 activities that are eligible to provide a substantial contribution to climate change mitigation, and a further 68 activities for adaptation. As an example, for climate change mitigation, this would cover generating renewable electricity, improving energy efficiency, or switching to the use of renewable materials. Own performance refers to an activity which is inherently sustainable and contributes to an environmental objective. So, for example, a company that produces solar electricity. However, the taxonomy also takes into consideration enabling activities, which provide products or services which directly enable another activity to make a substantial contribution to the objectives. For example, providing the parts for the equipment necessary to, say, make wind turbines. And in the context of climate change mitigation specifically, transitional activities which have no feasible low carbon alternative and which support the transition to a net zero economy are also covered. So, for example, hybrid cars are covered until 2025, after which they will no longer be covered. And an important thing to note in relation to transitional activities is they must also have best-in-class GHG levels, so greenhouse gas levels, within their sector or industry, not negatively impact the development of other low-carbon alternatives, and not lead to a lock-in of carbon-intensive assets. And lock-in simply means to create a technology which is costly and practically difficult to move away from. So the next criteria is to do no significant harm to other objectives. And again, the meaning of significant harm differs for each environmental objective, which you will find laid out in Article 12 of the draft regulation. This assessment ensures that progress against some of the objectives are not made at the expense of others. So here we have an example from Article 12 for climate change mitigation and adaptation. So where an activity leads to an increase in GHG emissions or leads to an increased negative effect of current and expected climate, it would not be classed as sustainable. TEG have also proposed 2 extra sets of criteria in relation to adaptation, including that activities must be resilient to climate change by ensuring that all material risks have been reduced as much as possible. And secondly, the services must not be delivered in a way that adversely affects the adaptation efforts of others. So TEG in their technical annex have listed the detailed criteria for the do no significant harm assessment, but just so far for economic activities relating to climate change mitigation and adaptation, and the rest will be released later on. And here we have an example from mitigation for solar electricity production. As you can see here in the red box, the significant harm assessment is broken down into each of the remaining environmental objectives and outlines the relevant criteria. So for some areas, there will be no relevant harm to a specific objective, as you can see here in this example for water and pollution. One thing to note, however, is that while the taxonomy covers economic activities that are responsible for over 93% of Scope 1 emissions in the EU, not all activities have been fully evaluated, and some haven't been included in the evaluation at all so far. However, over time, this will be expanded and completed. Moving on to the third criteria, users of the taxonomy will also need to comply with minimum social and governance safeguards. These include the standards embedded in the OECD guidelines, the UN Guiding Principles on Business and Human Rights, the ILO's Core Labour Conventions, and the Bill of Human Rights. So just to list some examples, under the OECD, companies should support and uphold good corporate governance principles. Under the ILO, companies should comply with anti-discrimination and equal remuneration conventions. And under the UN's Principle on Business and Human Rights and the Bill of Human Rights, companies should respect basic rights such as reasonable limitation of working hours and holiday pay. So these standards have a lot of overlap and are principles-based, so they don't necessarily require a materiality assessment as such. Most businesses should have no problem complying with this requirement, but it's still very important that businesses do consider these in more detail. Finally, the last requirement is compliance with technical screening criteria. And this, just like the do no significant harm criteria, is laid out in TEG's technical annex. The criteria will be contained in a delegated act, with the first set to be adopted by the end of this year, and the second set by the end of 2021. So here we have another example from solar electricity production under climate change mitigation, which we've taken directly from the technical annex. As you can see, the sector classification is listed here with the mitigation criteria outlined in detail there, as well as the rationale. Oops, apologies. The technical screening criteria also references other regulations and protocols, so users need to make sure they comply with all the requirements listed for their relevant economic activity. Again, not all economic sectors are covered. We only have criteria for climate change mitigation and adaptation for around 70 activities. But in time, most activities will be captured and the criteria for the requirements will be published soon. So that broadly covers the practical requirements of the regulation. And we appreciate that it's a lot of information, but the slides and the recording will be circulated after the webinar, and you can always refer to the regulatory documents online. So now I'll pass you back on to David, who will go through some key practical next steps to be thinking about.
Great, thank you, Rowan, for taking us through that. As you say, there's a lot of detail within there in terms of getting our heads around the implications of this. So with that in mind, in terms of next steps, the first thing to do was for companies to assess if compliance with the taxonomy is mandatory or is going to be voluntary for them as an organization. So that's the sort of obvious starting point from here. Even if it is voluntary, it would obviously still be beneficial for certain companies to state their compliance, as it sends a positive message to the company's understanding of sustainable activities. But as you say, you know, there's definitely a degree of work in terms of looking at this and aligning your information with this taxonomy. After that, users should identify which activities could be aligned with the taxonomy. So if they are impacted, then looking at the substantial contribution criteria. And then for each of those, verifying the technical screening criteria, the do no significant harm, and the minimum safeguards for those within there. Following from that, companies will then need to calculate the proportion of turnover and expenditure, and then start disclosing the information from there. So in terms of a few tips to start thinking about this, it's obviously very early days. And so initially it's really going to be about familiarizing yourself with this information and to look out for that final draft of the taxonomy regulations. As Rowan says, we're not anticipating there to be significant changes, but obviously it's good to ensure that that's there. And in terms of the FAQ information that we send, around if there's any significant updates when it is published, then we can certainly help to communicate those. So from there, it's good to obviously get your ducks in a row, looking at key dates and deadlines. As with any reporting, it's important to understand those and work back from them within your organization to be able to notify relevant ESG teams or contributors to this type of disclosure. It's also important that users really familiarize themselves with the actual 6 environmental objectives. So what we've covered today on those objectives, do have a look at the detail of those to see how those relate to your business, and looking at gathering the most relevant and reliable data on economic activities broken down according to those things. The TAG's technical annex is the most useful document at the moment to review that and do that. So we definitely encourage you to make the most of it and have a look at that technical annex document. So as today's overview has shown, there's a substantial amount of work for corporations and investors to demonstrate how much of their portfolio is sustainable underneath this new criteria. And in many cases, it will require gathering significant amounts of data, which may not be things that are currently gathered or understood. And in terms of the regulations, it's really only the start of a long transition of reporting and risk management standards. So companies, investors who don't comply with the regulations may be kind of out of significant sources of capital. And so, you know, as it evolves and grows and becomes more significant, it will become important that companies do consider the implications once it's more bedded in actually within the market. And we see how it develops beyond the sort of what it is at the moment in terms of the regulation stage. Great. So we've covered quite a bit of content today. We have had some questions through asking for some examples of specific things. So we'll be sure to include those in the FAQ documents that we send round so that we can put some examples within there, because that's the best way to really see that information. If you are starting to look at reporting and how you're doing that, and you want to look at software as an option to do that, obviously please do get in touch with Greenstone and we're able to talk to you more about that. We work within the lots of different solutions. Our frameworks module is where companies generally gather data from within their organization. So that's where within their business they may be using that to collect, aggregate, align, and report that information from within the framework side. And in addition to that, we have Investor Portal, which is an investor platform that's rolled out to portfolio companies to gather information. For some, may not be relevant, but for certain types of investors like venture capital trust, open-end funds, for example, you know, they may be that actually they're aligning what they're collecting from those organizations to be able to report at the fund level in alignment with the taxonomy information. Great. So thank you to everybody for attending today. There's just a couple of screenshots here as an example of the frameworks module, and then finally just to close on the investor portal side as well. So if you do want any more information about the software side, please do get in touch. If once you send through the FAQ information and share the slides further, if you do have specific questions or ideas about how the EU taxonomy might be embedded within your business or what you're seeing, then please do share those with us and we can continue that dialogue. Which just leaves me to thank Rowan for presenting today on the content side, to wish you all a good rest of the day. And yes, if you have further questions, then please do get in touch with us directly. Thank you.
Thanks very much.